Hello, we're going to examine how the B2T engine includes the foreign withholding taxes as part of its foreign tax credit calculation, or the FTC calculation. We know that the creditable foreign income taxes may also include foreign withholding taxes, which happens when a company receives a foreign payment of certain type, such as interests or royalty. For example, if a company is to receive a payment of $200 from a foreign payer, it may actually receive only $100. The foreign payer may withhold the other $100 and remit it to the foreign authority as the company's withholding tax. The company's home country may allow the company a foreign tax credit to alleviate its tax burden. The B2T engine handles that automatically as part of its FTC calculation, as long as the user maps its accounts to the standard account types. Here, we're going to use a simple example to show how the FTC calculation automatically includes the foreign withholding taxes. So here's our simple example, where we want to calculate a US company P that has a revenue of $1,000. And in this input file, in the setup sheet, we also tell the engine that there is an entity group P, where P is the parent company. And we also tell the engine that we do want to calculate the taxes for the group as well. But if you look into the whole file and we look in the recurring input, there's really nothing international about this whole input file. So the engine, when it's doing its calculation of items of international taxation or in tax, those items would all be zero because there's really nothing international about this input file or the situation. So let's add a little bit more interesting facts. Let's say the P of its $1,000 revenue, part of it is actually from a foreign country, Canada. And a P, while receiving the payment, was withheld $100. So P incurred a $100 foreign withholding tax expense. So let's add that fact into this input file. So here we have another record that says P has a foreign withholding expense account that has a balance of $100 expense, debit balance. Now we also have to tell the engine what exactly is this account. So we go to the setup input sheet and we are going to add an account mapping record to tell the engine. So we added an account mapping record to tell the engine that this account is a foreign withholding tax expense account. So that's it. And we're going to save it. And we're going to submit it to the B2T engine by using the easy button on the recurring input sheet at top. We can submit it. And the engine appears to start code. It may take 20 seconds to warm up. So it's down. Let's open the output file. So on the for the calculation of the P, and we see the current tax expense is $210, but there is a deferred tax benefit, $100. Why is that? Let's go to the provision sheet for P. The provision sheet, and we're going to pay special attention to the withholding related items. So we're going to see the related items of withholding tax expense. We see that it has an expense, but at the same time, there's a book to tax adjustment value of credit 100, essentially cancels it out. And there are some notes. Let's take a look at. It says, okay, see, so the engine reads is to use foreign tax withholding tax for tax credit purposes, and the engine is treated as true. So that withholding tax is being viewed to be used as a credit rather than deduction. So therefore, the engine is adding back the expense to the book income so that the taxable income would not include that part of the expense. This is being reflected in the current tax expense calculation. So the pre-tax book income is really 1,000 less that expense 900. However, there's a book tax adjustment to add that 100 back, and so the end result is you still have the taxable of 1,000. At 21%, you have 210. That's your current tax expense, and before any credits. Now, let's now turn our attention to the items of in tax, including FTC. The FTC for the current period is really nothing, zero. We were expecting to use that credit because we paid this $100. We're expecting to get that $100 back from IRS. And all the other international items is not our focus currently. So we look further down at the deferred tax calculation, though we do see that there is a deferred item. It is currently creditable tax from the withholding tax, but it's carried forward, so therefore it's deferred to other periods. So there's a deferred item, but not a current item. Why is that? So let's go further down into the actual foreign tax credit calculation for this single provision, P and the USA tax. Okay, we see that provision level, all these buckets, and we see the income is general income. Okay, because we don't, the engine really knows nothing specific, so it says the general income. For the general income, there's a foreign tax in this bucket, foreign tax 100. That sounds logical. $100, right? We had a withholding tax $100. So for the taxpayer, it is just that $100. So at the taxpayer level calculation, let's focusing on the first bucket, which is the general income. We have a foreign tax 100, but we have no foreign income. We just know there is an income 1,000. We just don't know any of this is a foreign income. And this is the U.S. tax and the U.S. worldwide income. So the limit, which is the foreign incomes times the effective U.S. tax rate, would also be zero. And because you're limited to zero, none of the 100 can be used in the current period. So it is zero. And all of this 100 will be carrying forward out of all the buckets. So nothing can be used in the current period. That's why the current tax benefit is nothing. But the carry forward, there is the 100 benefit over here. So now that explains why we saw the result that we saw a moment ago. Now, to make things a little bit more, you may wonder that how exactly is this $100 calculated? So let's go further down to the details, the detail sheet for P calculation. Now, we're also going to focus on the withholding tax. Okay. So the engine goes account by account. The trial balance from each of the account would contribute to each of these buckets over here. We see the foreign withholding is contributing $100 foreign tax, which makes sense, and it contributes no income. Well, it is tax, right? So, and for the adjustment of that account, There's no contribution to the foreign tax because remember the adjustment is for the U.S. tax purpose. It is adding back for the U.S. purpose income, not really the foreign tax. So from both the trial balance contribution and from the adjustment contribution, we totaled up coming down $100 for that bucket. So that's how this $100 foreign tax is from. It is collected from the buckets for each account and each of their book to tax adjustments. That's why we go back again, we see the $100. That's for that provision. So now one may ask, the company P really have received the payments, received revenue from Canadian payer. So therefore, how can we tell the engine that there is indeed some foreign income, right? Let's say $200. Okay. All right, let's do just that. So we close the input file. We close and go back to the input file. We close it, and here's our input file again. Okay, so we were saying that P has a revenue of $1,000, but we also want further tell the engine that $200 of it is actually from a Canada taxpayer. Okay, so to do that, there is a property that we can do so. So I'm going to show that property over here, make it a little bit clearer. There's a bunch of properties. One of it is called FTC, Foreign Source Income Allocation. So it's $1,000. We know that the $200 is from a foreign source, Canada. So we must tell the engine here. So for that account, we're going to enter FTC Foreign Source Income Allocation equal to, and foreign source could from a lot of countries, and so in our case we have only one country. We use a pipe separated key value pair, CAN, Canada country code, equal to 0.2 ending pipe. So here we simply says 20% of this trial balance is a foreign source income allocation. We allocate 20% of that. So engine now should know part of that revenue is foreign sourced. So there should be some foreign income in its calculation. So let's see that, what's going to happen. We save it. And we submit it again. And it's done. So we're going to open the output file. Now we see a little bit, it was like a deferred 100, now it deferred 58. Let's say, why is that? So we go to the provision sheet for P's calculation, and the same book to tax adjustment, no surprise here, because we still have to add back. It's not deductible because we're going to use it for tax credit purposes. And we go directly to the FTC calculation, and we go directly into the detail sheet. Now we see this for this bucket, the foreign income 200 shows up here for the P calculation. We go to details and take a look at FTC calculation. Now we take a look at the foreign that expense, withholding tax expense. It's still $100, but we look up one line. That's for the revenue. Foreign income 200. Okay. And we look at the notes over here, the explanation. It says for general income, User specified foreign source income allocation 0.2. So the engine knows your allocation and for the provider where exactly that property is located is on that trial balance, for example, on the revenue trial balance. So the engine knows that we are allocating 20% of that the trial balance as foreign income. So it has that. Now for all the trial balance contribution and nothing from a book to tax adjustment contribution, and we end up with 200 over here. And that's how we have the foreign income. And we go back. For the P calculation, we have the foreign income. At the tax, when we aggregate together, it is 200 again. So therefore, at the taxpayer level calculation, for this bucket, we have the foreign income 200. Multiply the effective U.S. tax rates, in this case 21%, we got 42 is our FTC limit. So therefore, for out of 100 expense, 42 can be used in the current period, and the rest 58 is going to be carried forward. So therefore, we add all the buckets together. We have the 42 current benefit and 58 deferred benefit. So we look back up. Okay. Deferred calculation, we have the 58 currently creditable, but we're going to carry forward 58, right? And we see the FTC current benefit. This is our current tax calculation. Current tax calculation, we have the 42 here. So it was 210, 42, and there's 168 is our total current expense. So that's how the foreign withholding tax is being automatically included in the FTC calculation. So to summarize, the B2T engine will automatically handle the foreign tax credits from the foreign withholding tax. The user only needs to map his relevant accounts to the standard account for the foreign withholding tax expense. And the user may also allocate his account balances by foreign income source countries so as to obtain more accurate FTC results. That's it. Thanks for watching.